Hey everyone, it's Janine here from the Wealth Building Academy, and today I wanted to talk to you about what a stock split actually is. So in this past little bit, we've seen two companies, Apple and Tesla, enter into a stock split, and many of you may be wondering what a stock split actually is. When a company is looking to maybe make their stock a little bit more affordable, they can enter into what's called a stock split. So it takes the total number of outstanding shares and the total valuation of those shares, and it divides them up just as you would expect. So Apple and Tesla most recently did a stock split. Tesla did a 5-to-1 and Apple did a 4-to-1. So what that means is if something is worth $1,000, for example, and it does a 5-to-1 stock split, then that stock of 1,000 would actually be split into 5 and you would get 5 $200 shares. This obviously decreases the market price, which can be attractive for investors that may be limited to investing in those companies that have multiple thousands of dollars for each outstanding share. But it doesn't really do a lot in terms of value for the investor if you're holding them, because you're going to probably have the exact same valuation after the stock split or immediately after the stock split as you would have beforehand. That being said, the market can absolutely react emotionally to that. So you could see a drastic increase or decrease in the price once the stock split occurs. When you're looking at whether or not to invest in a stock split, it's important to understand what kind of company you're investing in. I invested in the Netflix stock split right after it did the 7-to-1 a couple of years ago, and the stock price was down to about $99 a share. That was an attractive price for me to enter into the market at, and has done significantly well for me over the years. That being said, obviously it can go the other way, so it's important, again, to make sure you're researching those companies. From a tax perspective, there's not really anything you need to know. You'll still have the same cost basis. You'll just need to adjust it down for the increased number of shares that you will have. So if you, like I said, had $1,000 of a share, or one share was priced at $1,000 and there was a 2-for-1 stock split, the two stocks that you'll get will both have a cost basis of $500. But so when you go to sell it, it will be, let's say, sold at $600, you would take that $600 less that $500 to get your gain of about $100. I think stock splits are really interesting because they do lower the price for investors to be able to get into the market and invest in that share. But again, I would caution to be mindful of the emotional reaction. We usually see right after the stock split, the stock tends to jump, and then ultimately it comes down in general after a few hours or even a couple of days, depending on how much hype is around that stock split. If you have any questions about stock splits, please leave them in the comment section below. And if you enjoyed this video, please give it a thumbs up and subscribe to my channel, and I will see you next week.